Valens Research, Uniform Financial Analytics.
AbbVie is previously part of Abbott Labs, got spun out a few years ago. They are the pharmaceutical side of that business. What's really interesting when we look at AbbVie is obviously there are a bunch of things that should jump out here for you on a orange to blue basis, just showing how wrong as reported metrics, right? This company isn't really a 8% ROA business. It's a 40% ROA business. And it also is valued quite differently than the market thinks. But the thing that we want to highlight is this chart. What this is AbbVie's earnings per share in PE on an as reported and a uniform accounting basis. Well, we focus a lot on uniform accounting growth. We know everybody doesn't. Some people think about EPS growth, and also PEs, and that's really how you focus around valuations. Well, guess what? It's not just return on assets that offer on an as reported basis that don't show you what this company is really doing. It's EPS due. Earnings are just flat out wrong. On an as reported basis, it looks like EPS fell from $5.30 to $2.72 last year. It looks like AbbVie had returns and profitability collapse. In reality, EPS rose dramatically last year from $9.30 to $12.10. It rose, it didn't fall. And by the way, it was already almost twice as profitable as you thought it was in 2019 than the as reported metrics show. And now it's actually 4 times more profitable than the as reported metrics show, right? And that's just so powerful because that helps us realize not only is this company more profitable than the market realizes, the trend in EPS and profitability of this business and return trends for this business is directionally wrong on an as reported basis. You'd be thinking AbbVie is a declining, dying business if you were looking at as reported metrics. It's only with uniform accounting that you can see how strongly profitable this business is and how successful it is. And why, right, depending on when patent cliffs are and everything else, which are so important for valuing a pharma company, when we look at this company that has returns forecast to price to fall to 21%, if we believe in AbbVie's valuation, this company looks quite frankly cheap. In fact, let's actually look at how cheap this company looks. You can remember we use the embedded expectation tool with Alibaba to understand what is it the market was pricing Alibaba to do in different scenarios. Well, we can use this same tool to understand, well, what is a company worth based on what we think it could do? So for this one, let's say that we think that AbbVie's average average return is around 35%. That's what it has been, call it plus or minus, the last 7 years. Well, if we plug in that and we say, yeah, 7% asset growth is probably reasonable as a low end scenario here for the company, let's see what this company is worth. If you realize this company isn't declining, it's actually a stable, improving profitability business with pretty robust returns and pretty robust earnings power too. Well, what we can see is if AbbVie just does this, AbbVie's a double. AbbVie isn't worth $120 a share. It's worth almost $240 a share.
Valens Research, the world's leading source for uniform financial analytics.